Welcome back to Squawk on the Street. We're kicking off a week-long series focusing on where to find yield in this market. Our next guest manages a fund targeting companies that pay 2.5% or greater dividend yields. We're going to dive into her top picks in the non-energy, non-REIT space, including PNC, Lamar Advertising, and CRH. Sandy Pomeroy, Neuberger Berman Senior Portfolio Manager, joins us now. Sandy, it's good to have you.
Thank you. Nice to be here.
So first of all, are dividend strategies outperforming in this market?
No, they're not.
Why not?
They are, they're sort of the anti-tech trade, actually. And what we've noticed back in 2000, when tech was roaring back in 2000, dividend stocks did very poorly, but then went on to have a great, sort of 10-year period, actually a little bit longer, 12 years. And what we think is you're setting up for the next kind of move like that, because you've had these dividend-paying stocks underperform for the last almost 15 years, and they are as cheap as they were back in 2000. So we think this is presenting a very good opportunity for investors looking for income, and particularly for the valuation gap that we think is likely to close.
You think it switches from the market just wanting growth?
Yes.
To value and dividends?
Yes.
So where do you want to be? You like the banks, some of the banks?
The banks, we're okay on the banks. We have a decent amount of exposure there. You mentioned PNC, which has a 4% yield. I was tasked with giving you stocks that yield over 4%. And so, yes, that would be our top pick there. But actually, I like two other stocks I wanted to mention more. The first is Lamar Advertising. It is, you said also non-REIT, but this is a rhino, REIT in name only. It is a company that does billboard advertising. You notice it when you're on the highway and you're getting hungry and you see a McDonald's billboard sign, and you go in and you're like, McDonald's, three exits ahead. And they track you. They know when the cars pass and you go in there. So they can measure the success of their ads. And they are one of the largest billboard advertising companies in the country. And they have over a 4% dividend yield. Yeah. And we think it's very cheap.
Wow, 5.25.
Yes.
Are we, in general, in an environment of rising dividend yields, or do you worry about a period where they start to trim them?
Yeah, so we focus 100% on companies that can grow their dividends, because if you don't have a company that grows its dividend, you have a fixed income security, which we do not want. So we are focused on companies that have the capacity to grow their dividends for two reasons, either because they're growing their revenues, growing their margins, so just growing profitability, or maybe they're underpaying relative to what they're capable of paying out. So if the percentage of free cash flow they're paying out is very, very low, we like finding those companies too, because they can grow their dividends in an outsized way.
Where does energy fit in that spectrum?
Well, energy, they have just amazing yields now, because they're coming off of what were very good oil prices a year ago. We happen to think oil prices are going to stay reasonably high here. We're not expecting oil prices to trade back down to $55 or $50. So we think the yields in energy are very sustainable. They're not quite, 10, 12% that they were back in, last year, but they mostly have 5 to 6% dividends, which we think are sustainable.
And CRH is one that we don't talk about on TV every day, but has apparently a high dividend yield.
It is, it's a little bit of an under-the-radar kind of name. It's actually an Irish-listed name, which is about ready to list in the U.S. And so it's going to become a U.S.-listed company, but they are one of the largest suppliers of cement in the U.S. And they also have a big cement business in Europe. But cement is actually a great business to be in right now because of all the infrastructure spending we're doing. Capacity utilization in the cement industry in the United States is very, very high. It's almost at 100%, so we have to import cement. And so there's a pricing umbrella that all these cement companies get to actually operate under, which means that they're actually very, very profitable, and they can continue to pay that dividend and grow it.
Which is hotter now, dividends or buybacks for use of cash?
Well, we're only focused on companies that really want to grow their dividends. So we're, that's our primary.
There was a hope that would become more in vogue because of the buyback tax and the political environment.
I think that with the buyback tax still being quite low, the companies probably still, can favor that if they feel their stock's undervalued. But we're focused on companies that really want to make capital allocation priorities on paying dividends and growing those dividends. So that's what our fund is all about.